All right, welcome to day two of the Boat and RV 100 series. I'm Joe Downs with the Storage Moguls, and today I'm showing you the demand data behind this vertical, the 20-to-1 supply gap that's been compounding for 20 years, and why most investors have never actually stopped to look at it. This isn't theory. This is what we track across our own portfolio. And if you want to dig into these numbers with AI-powered tools and start applying them to markets you're evaluating, you should head to storagemoguls.ai and register to join our free network with GPT tools, multimodal learning, and content across every storage vertical. You can join the waitlist now and start free, advance at your own pace. But back to today, because the demand case for boat and RV storage is one of the most compelling I've seen in any asset class. So let's get into it. The single most important number in this vertical is 20-to-1. For every one new boat and RV storage space created in this country, roughly 20 new boats and RVs hit the road. 600,000 new units per year coming into the market. 25 to 30,000 new storage spaces to absorb them. And we're only counting boats and RVs, not jet skis, not ATVs, not personal watercraft, not tractor, not anything that goes on a trailer. The real imbalance is even bigger than the headline number. And this isn't new. The gap has been compounding since 2005. Most investors have never stopped to look at it, but now you have. Three numbers, that's all you need to understand this market. 13 million registered boats in the United States. That's the existing owner base, people who already have a boat and need somewhere to put it. 600,000 new boats and RVs added every year. That's conservative. That's boats and RVs only. Again, doesn't count jet skis, ATVs, personal watercraft. The real number of new recreational vehicles needing storage is meaningfully higher. And 20-to-1, for every new storage space created, 20 new vehicles are looking for one. That's the gap. That's what you're investing into. And here's what makes this different from a hot sector story. These numbers have been building since 2005. So it's not a hot sector story. This is structural. It compounds quietly while most investors are chasing whatever asset class is trending. Here's the question I get from every investor who looks into this data for the first time. Is this a COVID thing? It is not. Boat and RV ownership was growing steadily from 2005 onward. COVID accelerated it for sure. Millions of new participants got into outdoor recreation for the first time, but the trend line was already there before COVID. It spiked, the sales of new vehicles. It dropped slightly below the next year and a half, and it's right back. After the COVID peak, demand dipped, like I just said, and then returned to the trend line, actually above it, and continued upwards. The supply side is the other half of the story. Building a boat and RV facility is slow and hard. You need land, usually in the outskirts where zoning allows outdoor storage. And by hard, I don't mean hard to do. I mean hard to be able to do, because you need entitlements, you need capital. You're looking at 18 to 36 months from decision to opening day. And that's why supply can't respond quickly even when demand is obvious. The gap doesn't close because the structural forces on both sides are pulling in the same direction. More demand, slow supply response. That's the investment thesis in two sentences. Why can't supply catch up? Three reasons. Zoning. Outdoor vehicle storage is restricted or requires a special use permit in most municipalities. You can't just buy land and open a facility. Every new boat and RV operation is a permitting process, some easy, some a 2-year fight. That friction limits how fast supply can respond. Capital. The institutional investors who built out self-storage at scale, the REITs, the private equity, they haven't arrived in boat and RV yet. The asset class is operationally complex, or at least relatively speaking, to self-storage, and doesn't fit a cookie-cutter model for the most part. So most of the supply being created is actually being created by mom and pops. Individual operators building one facility at a time, and that's slow. And then timeline. Even a motivated, well-capitalized developer is looking at 18 to 36 months from land acquisition to opening day, and you can't flip a switch. Demand moves in real time, supply doesn't. Bottom line, the three brakes on supply aren't going away, and that's the opportunity. So demand keeps growing. Three reasons why that's not changing. First, the outdoor lifestyle shift. COVID didn't create the trend, it accelerated it. Millions of people experience outdoor recreation for the first time, or for the first time in a long time, between 2020 and 2022. Golf clubs, RV parks, lake houses, everything outdoors boomed and stayed elevated. People who discovered they enjoy taking a boat out on a Saturday don't stop enjoying it just because COVID's over. That's a permanent new participant in this market. Second, HOA and municipal bans. This is this is the one that most investors miss completely. Across the country, HOAs are banning outdoor storage of boats and RVs in driveways and side yards. Municipalities are following. In dense HOA markets, think like outside of Boston, outside of Phoenix, suburban Chicago, waiting lists at boat facilities can run up to a year. Government regulation is inadvertently building your waiting list for you. And then third, the generational transfer. Baby boomers own a significant portion of the boats and RVs in this country. As those assets transfer to the next generation, kids, grandkids, estate sales, you get a new wave of owners with storage needs. That wave is just the beginning. So here's the context that puts all this demand and data in perspective. Self-storage 20, 25 years ago was fragmented, mom and pop dominated, no REIT presence at scale. Operators who understand the supply-demand dynamics and moved early built significant wealth before public storage and extra space and CubeSmart arrived and compressed returns across the sector. Boat and RV storage today, fragmented, mom and pop dominated. REITs have largely stayed out to this point. The institutional capital that compressed self-storage returns has not arrived here yet, but that's not permanent. Institutional investors are watching this space. The window where operators have a structural advantage over passive capital is real, and it has a clock on it. Recently, I interviewed Sydney Wilda of Anytime Storage, and she had a great line. She framed it right way. This is what self-storage was 20, 25 years ago. Pay attention. So what does all this demand data actually mean for how you invest? It means you can reverse engineer your market selection from the data. High HOA density in your target area, for instance, that's forced demand. Proximity to lakes and rivers, forced demand. Organic demand, actually. Pull the county boat and RV registrations. Count the existing facilities. The supply gap in your specific market is a number you can calculate before you even look at a single deal. And it means right now, we're in mid-March, start of the spring move-out season is one of the best times of year to be doing market research. Dealers are talking to boat and RV owners who need storage. Marina operators know which facilities are full. The market is active. The intelligence is available. Tomorrow, day 3, we're going to shift from the demand side to the tenant side, because the single biggest conceptual mistake self-storage investors make when they cross over to this vertical isn't about the numbers. It's about who they're dealing with. And that changes everything about how you operate. Okay. Next up, day 3, we'll dive into this is not self-storage with bigger units, the tenant mindset shift. Please like this video if you've been overlooking boat and RV storage because you thought it was just a scaled up parking lot. And subscribe so you never miss the window on a structural supply gap that's been building for 20 years. And finally, share this with someone who thinks outdoor storage is a niche play with no real upside. They're going to thank you later. And remember, a 20-to-1 supply gap in a fragmented mom and pop market is exactly where generational wealth gets built. The data is right in front of you. For the full demand framework and deal analyzer, join the Storage Moguls community for free at storagemoguls.ai. We're in the early days of this series, and what we're building toward is a complete operator playbook for boat and RV storage investing. We just finished the complete playbook for self-storage investing. So if you missed it, go back and watch that too. But the demand story is just the foundation. So stay tuned.